Hi, my name is Nicole. Today I'm helping a hospital decide whether or not it should invest in a new piece of medical equipment. The equipment costs $1 million upfront, and that's including the shipping and installation fees. It's expected to return $250,000 in operating cash flow in year one, and then the operating cash flow associated with this project is projected to increase by 5% each year. The total length of the project is 5 years, and the cost of capital associated with the project is 18% after adjusting for risk. Based on this information, should the hospital invest in the new equipment or not? I'm going to solve this problem using Excel today. In order to figure out whether or not this new piece of medical equipment that the hospital wants to invest in is a good idea or not, I'm going to begin by putting the information that was given in the question in a timeline. So we'll get the timeline going here. So we'll have year 0 here, year 1, year 2, year 3, year 4, and we're told that the project is a 5-year project, so I'm only going to put the timeline up to year 5. I'm also going to put the net cash flow in. So we know that in year 0, it would cost the hospital $1 million to purchase the equipment. I'm going to show this with a negative number and put negative 1 million there. That shows how much they paid out to get the equipment. I'm told that in year 1, the operating cash flow is $250,000. So I put $250,000 there. And year 2 says that it's projected to increase the operating income by 5%. So what I'm going to do is multiply the amount that was obtained in year 1, the $250,000, and multiply it by 1.05. So that's 5% larger than what it was in year 1. So I get my operating cash flow for year 2. Year 3 is the same. It's 5% more than the previous year. So I go to year 2 and multiply by 1.05 and do the same for year 4 and the same for year 5. I'm also told in the question that the project's risk-adjusted opportunity cost of capital is 18%. So I'm going to put the opportunity cost of capital in here as well so that I can see it. And it's 18%. One way to tell whether or not this is a financially sound decision to invest in this equipment is to find out the net present value of the project. If the net present value that I obtain is negative, it means the project will be losing money. The operating cash flow that it's generating is less than the amount that I have to put up initially. So in order to calculate the net present value, I can use the NPV formula. And so I can enter the arguments here. It's asking for the rate. The rate that I'm going to use is the 18%. It's the opportunity cost of capital. In other words, it's the return that I would expect on a project of similar risk. And then the values that I'm going to enter are the one from year 1, year 2, year 3, whoops, year 3, year 4, and year 5. All right. You'll notice that I didn't include year 0 in this calculation. That's because year 0 is a present value. So the net present value function is discounting the other year cash flows according to the opportunity cost rate. But we don't need to discount the value in year 0 at all because it's already in the present value. So I've got that in the function there. However, this net present value figure is not accounting for the $1 million that I put up front. In order to make it account for the $1 million, I'm going to add back the $1 million separately. So the net present value function has the opportunity cost right here, and then it has all of the values from years 1 through 5. But I add year 0 in separately to account for the $1 million that I pay up front. That gives me a net present value that's negative. It's negative $149,758.53. So according to the net present value alone, this is not looking like a favorable investment. The other way that I can look at this is to calculate the IRR, or the internal rate of return of the project. When I'm looking at the IRR, I'm looking to have an IRR that is larger than the opportunity cost of capital. So if the IRR is greater than the cost of capital, it means that I'm making more than I would make in a similar investment of similar risk. So I'm going to do this. Generally, the IRR and the net present value will give the same decision. If the net present value says it's a bad decision, then the internal rate of return will go along with that. They won't contradict each other, so it's a good way to double check whether you've done them right. In order to calculate the internal rate of return, I'm going to use the IRR function. And the IRR function simply asks for all of the values. There's no need to add anything separately. You just select all of the cash flows for all of the years that you want to look at. And it gives me an IRR of 11%. So this 11% is lower than the 18% cost of capital, which means that it's not returning the same amount that I would expect in a similar investment. So since the internal rate of return is lower than the cost of capital, and we have a net present value that's negative, we should not invest in this project. The project does not generate enough operating cash flows to compensate the hospital for its investment cost.